Anything bad that happens around the world could happen here. We are not immune. Really bad inflation comes no matter what the central bank does. Really, you need solid fiscal policies to contain our hyperinflation. All hyperinflations have ended when the fiscal problem ended.
It's my pleasure to welcome back Professor John Cochrane. He is the senior fellow at the Hoover Institution at Stanford University. He was previously a professor of finance at the University of Chicago's Booth School of Business, and his research has spanned several academic journals and books, including The Fiscal Theory of the Price Level. He blogs at The Grumpy Economist. Very good site. You should check that out. Link down below in the description. We'll be talking about his outlook on the macroeconomic growth picture for the U.S., as well as inflation. Welcome back, Professor Cochrane.
Always a pleasure to be here.
Thank you very much. Let's start by talking about some recent news. Vice President Kamala Harris recently proposed that she would end price gouging at the corporate level, especially for grocery stores. Now, before we talk about the particulars of her plan, can we just address the principle of addressing price gouging and perhaps what the government can do to address this issue? Is price controls one of these solutions, or are they, do they usually use something else?
Well, let's start with, is price gouging a problem? And in particular, she's vulnerable on inflation because she and Biden have been in charge for 4 years, and we've seen an inflation like we haven't seen since the 1970s. So that's sort of like the number one macroeconomic competence is don't let inflation break out on your watch. So what happened to inflation? Since I just wrote a blog post on the Emperor Diocletian, but for thousands of years, every time there's an inflation, the politicians round up the usual suspects: greed, price gouging, monopolists, hoarders, middlemen, and it usually goes wrong. Of course, it has nothing to do with why we had inflation. Inflation is a decline in the value of the currency because they printed up too much money and handed it out to people. So it doesn't. Price gouging has really nothing to do with inflation. And, did corporations suddenly wake up and become greedy all of a sudden in 2021? And they weren't greedy before? It's just ridiculous. Groceries in particular. It's one of the smallest margin businesses around. So the idea that you make groceries cheaper by trying to hound companies to lower prices below their costs, well, that doesn't work. They gotta pay their costs like everybody else.
Okay, well, let's just take a listen to this 60-second clip of Kamala Harris on the campaign trail about her plan, or what she, in principle, intends to do. Let's take a listen here.
We believe in a future where we lower the cost of living for America's families so that they have a chance not just to get by, but to get ahead. Because while our economy is doing well by many measures, prices for everyday things like groceries are still too high. You know it and I know it. When I was Attorney General, I went after price-fixing schemes. And when I am president, it will be a day one priority to fight to bring down prices. I will take on big corporations that engage in illegal price gouging. I will take on corporate landlords that unfairly raise rents on working families. I will take on big pharma and cap the cost of prescription drugs for all Americans. And continue to bring manufacturing jobs back to America.
Lots to unpack there. First of all, illegal price fixing of corporations. What is she referring to, Professor?
Well, that's a good question. Well, there's a Federal Trade Commission, and you are not allowed to engage in monopolistic practices. So we're going to unleash Lena Khan and her buddies at the FTC. Well, they're already unleashed, but send them after price gouging. Look, lowering the cost of living is a great idea, but the trifecta of tariffs, subsidies, rent controls, protections, mandates, high taxes, mandates, you must spend money on childcare and all sorts of things. Buy American, all that's designed to raise costs. The source of high prices is not price gouging, monopoly, all the rest of it. No, I'm trying to understand this because this is economic nonsense. And, we've known this for hundreds of years. What's going on? Well, they've been going after big corporations for decades. And it looks to me like the answer is always the same. The questions just change. And so that's the one way to understand it is this is political. This isn't economics. And so you are going to go attack big corporations. And that seems, if you analyze it politically, that makes sense. Nationwide rent control, there's another horrible idea designed to, you could lower costs for the few who are lucky to get it, and then you can destroy the stock of housing. Great.
She said she would cap the cost of drugs. Capping the price of anything, in principle, wouldn't that end inflation if we were to just implement price controls and allow only a certain margin of inflation per year? Wouldn't that just fix
it? Look at measured inflation, but price controls don't allow. It doesn't mean that you can buy anything at those prices. So there's only so much to go around. And either you ration it by higher prices, or you ration it by waiting in line, or you ration it by who's politically powerful and can get the stuff sent their way. So we've had long experience with price controls, and it never works. It just destroys markets and destroys the economy.
All right. So you don't think these ideas could work. What should they do then? Whoever is in the White House come January next year, what should they do to, I guess, maintain a reasonable level of inflation?
Oh, well, inflation, half of it's the Federal Reserve and half of it is too much borrowed money being thrown around. Inflation is not about prices. I know that's like only an economist could say something like that.
Yeah, what do you mean
by that,
Professor?
All of these stories are about, greed is about trying to raise prices relative to wages. Inflation is about everything going up at the same time. Inflation is one and only one price. It's a decline in the value of the currency. Where did it come from? Because they printed up a ton of money and threw it out. And people tried to spend it and drove up prices. So inflation's always and everywhere monetary and fiscal policy. So what should they do? Yeah. Get monetary and fiscal policy under control for inflation. And lowering costs is a great idea, but lowering costs doesn't come. If the president could just say, I command drug prices to be lower. Well, that's a great idea. Why don't we just command food prices to be lower and command car prices to be lower? But you can't command people to actually sell stuff at those prices.
Have you done work on sort of the golden growth rate of inflation, or the equilibrium growth rate, such that we have good, sustainable, long-run, real growth in the economy without having too much inflation?
I know that's okay, great. I'm glad to get off of presidential politics. That's a great question, and one that economists debate. My preferred growth rate of inflation is zero. Why should we steadily shrink the value of the dollar 2% every year? A lot of economists like the idea of 2%. Central banks like the idea of 2% in the future, and we forget whatever mistakes we made in the past. But how about zero? How about what the Fed's actual mandate is, which says price stability? That means that the price level is about the same. We don't shrink the yard 2% every year to try and goose up, let people who sell clothes get 2%, sneak 2% less clothes to us every year. Why should we change the standard of prices 2% every year? So I like zero.
2.9% was the latest reading. Do you have an outlook for us, Professor, in terms of whether or not the Fed could sustainably get it down below 2.5 towards 2%?
Well, it's not just the Fed. As we learned where did our inflation come from? Bless the Fed, it did not come from the Fed. Inflation that we had in 2021 and 2022 clearly came from fiscal policy. So first of all, the Fed is important. And the Fed helps, but we're not really going to get inflation permanently under control until we get fiscal policy under control. Now, the outlook for inflation, forecasts are dangerous because you're always wrong. And inflation's like the stock market. If anybody really knew that inflation would be 10% next year, what would they do? They'd raise their prices now, have inflation now, just like stocks. It's always going to be hard to forecast. With that said, though, I think we are in a fragile state. Sort of like the late 1970s, that inflation could well surge again. Inflation all comes down to people have faith in the stability of the U.S. government, its fiscal and monetary policies. And when they say, these jokers don't know what they're doing, inflation breaks out, especially if we get a recession or another global emergency. And this, let's replay 2021, another a global emergency recession, our government tries to borrow and spend another $5 or $10 trillion, are people really going to say, oh, well, sure, here's more money. We know you're good for it. Or they're going to say, look what just happened to us last time when you inflated away 15% of the value of our government bonds. No, we're not handing you the money. Then we get into trouble pretty fast.
You brought up government debt and spending. So the deficit is expected to widen. This is a projection by the CBO. And so is the debt as a percentage of GDP, by the way. What is this going to do to the inflation rate in the long term?
Well, the CBO is projections, and they say this will not happen. This is unsustainable. The only question is, how are we going to get around it? Are we going to, as Winston Churchill, I guess, did not say, do the right thing after we try everything else? Or we're not. What you need is pro-growth policy. We should get back, there are plenty of policies to lower costs and get growth of the American economy going. And with more growth comes more tax revenue to pay off all our big bills. So growth is really the answer. But growth does not come from trying to command the oceans to part. Growth comes from actually lowering costs, getting rid of all the subsidies, getting rid of all the protections, getting rid of all the inefficiencies. Kamala Harris wants to build houses. Good idea. But we got all sorts of zoning laws and building codes that don't let you build houses. If you just subsidize people to buy more houses and you don't let them build more houses, what do you get? More expensive houses. So a grand program of getting out of the way would really help on growth, on tax revenue, on paying off the debt. And then at some point, you got to get a hold of, we have European entitlements and American taxes. Those don't add up.
So you talked about how inflation is driven by fiscal and monetary policies. Is it driven also by consumer strength and ultimately demand? And is there a relationship between the labor market and inflation?
Well, it is all ultimately demand in the sense that where does inflation come from? Give people $5 trillion extra bucks, they go out and try to spend it, and that pushes up prices. And all these stories about the price of, EVs, that is where inflation comes from.
We're assuming if we give people money, Professor, they'll spend it. The savings rate remains the same. They wouldn't just save and hoard the money, correct?
That is very perceptive. Yes. And here, this is sort of the insight of fiscal theory of the price level. Suppose you give people money or give people government debt. It's all the same thing. But they regard that as a great savings vehicle. They say, oh, boy, this is a great way to save rather than spend. They trust that debt's going to be paid off and give them a good rate of return. Then they hang on to it. You don't get inflation. So that's the real key problem of the big deficits of 2020, 2021 was not deficits. Deficits and debt are a great and wonderful thing. They let governments get through temporary big crises like COVID and then pay them back. The big problem is people didn't have the faith that it would get paid back, so they tried to spend it quickly. So it's the problem is huge amounts of money without those CBO forecasts of how this is going to get paid back, and then it turns a savings vehicle into a let's spend it now before it all vanishes. And then you get inflation.
What about the labor market? Is there the Phillips curve, does that hold the inverse relationship between unemployment and inflation? I ask this because the unemployment rate has been ticking up, as you know, 4.3% latest reading, while the inflation rate has been going the opposite direction.
The great Phillips correlation. You pointed at, one of the things. Here's what I know from 50 years of studying every model of finance, that nobody knows anything.
Okay.
I can tell you with great precision that when they say we understand how it works, they don't know how it works. So that is the standard line, that the way the Fed affects inflation is by creating somewhat of a recession that makes the labor market slack. And for some reason, that makes also all prices and wages go down. It doesn't work. The theory is kind of blown up, and the correlation is barely there in the data. I mean, remember, just before COVID, we had 3.6% unemployment and no inflation. Then COVID comes and we get, a lot of inflation, and then we get 3.6 unemployment and a lot of inflation. I don't know what's different. So that's one of the sort of standard myths of macro that is unfortunate. We don't have better myths, but that's sort of the standard in the business cycle. And what just happened? Inflation came down before the Fed really raised interest rates, and there was no recession.
Yeah.
So the whole Phillips curve idea that you have to create a recession, you have to create a lot of unemployment, and that drives inflation. That's one data point. 1982 is when that happened, but it just didn't happen now. So I would put much less faith than usual in the Phillips curve.
So people still are concerned about prices, the level of prices that it hasn't come down for most people. Are we going to get deflation? Well, I guess it's a two-part question. Should we have deflation, and how likely is it that we will get deflation across the board?
I do not think deflation is likely.
Okay.
Oh, good. Finally make a forecast. This is of all the many confusions in our political discussion, let's distinguish inflation from the level of prices.
Yes.
Inflation is the rate of change of prices. So what happened is for 2 years, we had a very high inflation rate, which is now moderating. It's about 2.5% at the latest. But that the level of prices, you go up a hill for quite a while, and then you get to the top of the hill and you level off. You haven't gone back down to the valley. You're just not climbing any more hills. So that's where we are. So basically what happened is we printed up a lot of money. We gave it to people. They tried to spend it. They raised prices until the amount of money and debt we have in real terms is back to where it was. There's no force there for prices coming back down again. So under current policies, I don't see any chance of prices going back down. Just inflation moderates until something bad happens, and then inflation goes back up again.
Do we need to have something bad happen for inflation to come down usually?
No. Inflation, big inflations are always cured by, for inflation to come down. There's inflation and recessions are separate things. For inflation to come down, if we get a really big inflation, or if inflation turns out to be endemic like it was in the 1970s, it'll take a joint fiscal, monetary, and microeconomic reform. That's what it always takes to end inflation. There might be a short-run thing. If we get a recession, there will be a temporary decline in inflation. That very typically happens in a steep recession, is you do get a decline in inflation. But you might also get stagflation, like happened in the 1970s, or inflation that goes down briefly and then comes back roaring afterwards.
Are recessions usually disinflationary events?
Yes. Usually there is a decline of inflation with recessions. Lately, it hasn't been very big. I mean, in 1933, the price level went down 30%. You got a big deflation. That's not going to happen again because that was a quirk of the gold standard. We're not on the gold standard anymore. So 2008, inflation went down to, there was a little bit of deflation, and then it came back to about 1 or 2%. And the COVID recession, we had a huge recession. Inflation went down from like 2% to about 0, and then went back up to 2% again before it exploded. So there'll be, if there's a recession, there'll be a little easing of inflation. But I don't see anything that is going to lead us to major deflations in a recession. Speaking
of the gold standard, some people have pointed out that during the Bretton Woods era, inflation was relatively low, and they've attributed that low inflation to the fact that the dollar was tied to gold. First of all, is that just a correlation and not causation? And second, should we go back to the gold standard?
The second answer is no.
Okay.
Standard is yes. So the gold standard was, while it worked, a reasonably effective defense against inflation, because it was harder for the government to just print up money and hand it out. Now, the government never had enough gold to back all the money. So gold standard was really a constraint on fiscal policy. It meant that the government was committed. If people came with their money and said, give me gold, the government's committed to raise taxes or to credibly promise future taxes so it could borrow the gold and somehow get the gold to give people the gold. So it was a commitment, not to overdo it on fiscal policy. Gold standard has two big flaws. And the first big flaw is you've seen the price of gold goes up and down and up and down. Would you rather the price of gold were constant, the price of everything else goes up and down and up and down? Inflation was very volatile under the gold standard. And the other big problem was deflation. So in 1933, the value of gold and money was held its value relative to gold. Fine, we're on the gold standard. Those went up, but there was a horrible deflation in everything else, which was not a good policy. So the gold standard and gold just would not work in a modern economy. The gold standard is a way of, when you have gold coins that circulate as money, then you can create notes that represent the gold coins, and that works okay. It sort of expands the gold coins. But we don't have gold coins that circulate as money. So the foundation of the gold standard doesn't exist for the modern economy. So I understand the people who want this, their hearts are in the right place. They want the Fed to be more mechanical. They want it to be less sort of the grand poobahs the man behind the curtain pulling the strings. They want some sort of rule. That's all great and wonderful thoughts, but going back to gold would not work for the U.S. economy.
I know you like to debunk myths, so let's address one of the myths that I've seen on social media a lot. Or I don't know if this is a myth. I'll let you address this. The prognosis that the U.S. could one day have hyperinflation, precisely for the reasons that we talked about: higher levels of debt deficit, more money printing, etc. Hyperinflation in the U.S. How likely is this scenario?
Well, I hope not likely, because the U.S. does not face right now an external threat. If we have a hyperinflation, it's entirely because we're shooting ourselves in the foot and refuse to do basic reforms that your grandmother understands, in her budgeting. But the other fact is that anything bad that happens around the world could happen here. We are not immune. So the same forces that lead to hyperinflation in Argentina have led to hyperinflation in Argentina. Actually, they're doing a wonderful job right now on inflation. Get rid of the rent control and cure the fiscal policy. All of a sudden, rents go way down, and there's more apartments to rent, and inflation goes away. But the bad things that have happened in Argentina could happen here if we don't get serious about just basic standard, got to pay back your debts kind of fiscal and monetary policy.
Well, the monetary policy would have to be a lot looser for this to happen, would it not?
Well, really bad inflation comes no matter what the central bank does. So if you're the central bank of Argentina and the government is printing up money and handing it out, there's not much you can do as the central bank of Argentina to stop the inflation. People are running away from government debt, and money is just a different form of government debt. So ultimately, really, you need solid fiscal policies to contain hyperinflation. All hyperinflations have ended when the fiscal problem ended, the thing that was forcing the government to print up money to hand out to pay its bills. That's where hyperinflation comes from.
I'd like to close off on something you wrote in The Grumpy Economist recently. You said, I've spent my whole economics career on two great mysteries. Why do stock markets crash, and why are there recessions? At the end, I can only report that I still don't know, but I do know with great precision that nobody else knows either. So then at that point, you took a look at some stories going around and probe whether they make sense. One of them is that the stock market decline or crash, 1 day, 2 day crash that we saw earlier last week was a result of the unwinding of the Japanese yen carry trade. And you went on to describe how you think that may not be the case. Can you just break that down in layman terms? Why or why not?
Well, there is a tension in how we think about finance. So the story of the carry trade was a lot of people borrowed money in yen and invested in U.S. stocks. The yen went up and they go, we lost a ton of money here. And so they dump their U.S. stocks, and that sends the stock price down. But the tension, all of the theory of finance says, okay, well, if you were not in the carry trade, thought that stocks were a good deal yesterday and stocks go down 10%, you should think they're a better deal today, and you go buy them. So for every seller, when stocks trade, every time someone sells, someone else has to buy. And so there should be, other investors fundamental investors who are willing to buy and then get the prices back up again. So the technical things like somebody having to sell a lot should not really deeply affect stock prices. Stock prices should end up as the present value of dividends. If the present value of dividends hasn't changed, then when you sell, I'm happy to buy. Now, but stock prices do jump up and down a lot. And there's a fact that one of the fascinating things of modern finance, when people dump a lot of stocks, the price does seem to go down for a while. And I think that's exactly what we saw this time, that there was this short run, selling pressure from these guys unwinding spectacularly bad trades. We can get into that later. The same fallacies go on over and over again. But then since there wasn't really any fundamental news, a little blip on the labor report, who cares about that? Basically, fundamental investors came back in and bought up all the stuff that people were selling. So it's a great example of the stock market's working the way they should work rather than a big puzzle in the end.
I know you don't give predictions per se, but this just came out today. Big short investor Michael Burry. Apparently he dumps gold and he's ditching gold for a bold bet, apparently on the dollar, the U.S. job market, Chinese stocks. Basically, he's more risk on now. Is he? I mean, and do you agree with this particular macroeconomic picture that perhaps we're getting some sort of rebound in growth?
Who knows? Here's how macro works. We're going to grow slowly until something bad happens, and then we'll get a recession. Recessions seem to need a spark. Now, sometimes the spark is there's a decline in the growth, and then something goes wrong. But, if China's debt situation explodes, if banks turn out to have all sorts of commercial real estate that they don't know what to do with, something financial has to go bad, and then you get a recession. The real macroeconomic story, the sad one, is that our long run growth rate is too low. Our long run growth rate was almost 4% from World War II to 2000. It's cut down to 2% now, and long run growth in Europe has gone down to 0. So, that's the one we should be paying more attention to. But that's a longer run thing. So, the macro outlook, mine is we trundle along with unemployment around 4% and slow but positive growth until something bad happens. As far as, the risk on versus risk off bet, there is, I would say, an exactly half chance that he's right and an exactly a half chance that he's wrong. Here's my piece of investment advice. If you do anything other than just hold the market portfolio, hold a big everything, that is a zero-sum game. Because everything, if I hold more, you have to hold less, right? So there's a winner and a loser. So anything else than total portfolio is a zero-sum game. Now, why play a zero-sum game? Because you think you're smarter than the other guy. Guess what? He thinks he's smarter than you. One of the two of you is completely deluded. So look around the table. There's the shark and there's the mark. Are you the shark or are you the mark? Half of you are the mark.
We're running. We probably don't have time for this discussion, but I'm guessing you're an advocate for the efficient market hypothesis.
Well, broadly speaking, markets are, even Gene Fama says markets are not 100% efficient.
Yes,
but they're a lot more efficient than most amateur traders think they are.
Okay. I'd like to close off on this question. So way back, I believe in 2017, I attended a CFA Institute event. Janet Yellen was an honorary guest speaker, and she said, much to the crowd's amusement, recessions are caused by two things: financial imbalances and the Fed. Can you address what she said here? Is that true, that the Fed creates economic cycles?
In the modern world, I think she's exactly right. I mean, so except for the big one,
Okay. Yes.
The last workshop. So the COVID recession was caused by a pandemic. That was not, when people aren't going out because they don't want to get sick and the government has locked down all the businesses, that has nothing to do with financial imbalances of the Fed. But other than that one, historically, countries had famines and crop failures and so on. So there's more supply historically. But the U.S. recession since World War II were, this is Milton Friedman's great contribution. The Fed mistakes caused a lot of the post-war regression. They haven't really happened lately. So, 1980 was caused by the Fed deliberately. They caused a recession to slow down inflation. But 2000, 2008, and COVID was COVID. 2000, 2008 were clearly caused. 2000 had something. It was a mild recession having to do with the implosion of the tech stock. 2008, of course, is the poster child for why was that a severe recession? The recession was coming. The economy was slowing down, and then the banks all blew up, and you couldn't get a loan. So that's a clear sign that the financial problems are at the heart of serious recessions. And clearly 1929 to 1933 was a financial problem. Now the Fed did tighten. The Fed decided the stock market was too high in the late 1920s and decided to tighten. And so the Fed was involved, and the Fed was clearly involved in the 1920s by not responding. They tightened money as things were going down. The Fed was responsible there. I don't know. The Fed was not responsible primarily for 2008. That was a banking crisis.
Yes. Okay.
So yes, modern recessions, except for ones associated with a big supply shock like COVID, are mostly either the Fed squeezing too tightly, and that's why people want a more rules-oriented Fed. The Fed kind of overdoes it, bing, and then next thing you know, you get a recession or a financial crisis.
Well, thanks for breaking things down for us. Where can we learn from you? Well, where should we go to read your work?
Thank you. Yes, Grumpy Economist, which is now on Substack, or johnhcochrane.com, which has all of my academic work and books and links to other writing.
Okay, we'll put those links in the description down below. Make sure to check that out. Thank you very much, Professor Cochrane. Speak again soon. Thank you.
Always good to talk to you.
And thank you for watching. Don't forget to like and subscribe and follow Professor Cochrane. The links down below.